Hi, this is Jim Cunningham, and today we're going to talk about how to cut a tax bill when selling real property. So, if you're going to sell property and you're worried about paying taxes, you really want to watch this. Disclaimer, I'm a lawyer, I'm talking. This is not legal advice. Do not watch this and go out and do a bunch of stuff yourself. The reason you hire a professional is because they know how to do stuff that you don't know how to do. I'm all about education, but go ahead and subscribe to our YouTube channel. We're doing this live. This will be put on YouTube later today. So if we go through this and you're like, wow, Jim, you talked so fast. You went through that stuff so fast. I really need to watch this again. It will be on YouTube for your viewing pleasure. You go ahead and hit subscribe. You can also share that with someone who might find value with the content. We do have offices in Northern and Southern California. And you can see here, we've got the Golden Gate Bridge and a beautiful shot of Southern California. These are our current lawyers at Cunningham Legal. All we do is trust and estate and tax planning matters. That's all we're zeroed in on, super laser focused. I have been an attorney for over 25 years. I think when you hit 25 years, you just say over 25 years. We help clients. Our firm helps clients in other states as well. I'm a certified specialist in estate planning, trust, and probate law. I'm also a securities and insurance license, as well as a real estate broker and a private pilot. So kind of a broad background. But what I spend most of my time involved with is being a certified specialist in estate planning and a lot of the skill set that comes with being a broker, a real estate broker. So we're going to talk about how to sell, how to cut your tax bill when you sell property. So something to understand is sales of real property are subject to something called capital gains tax on a federal level, and that's going to be 20%. And there is a 3.8% net investment income tax that you don't want to ignore that. It's also called NIT, N-I-I-T. So it's 23.8 federally. The state of California. So if, we're in California, so a lot of what we talk about is California. If you are a California resident or own property in California, and this is really important, you can be living in Texas. If you sell a piece of property in California and you realize a capital gain, you're going to owe capital gains tax or California state income tax on that, as well as the federal tax. So just because you moved to Texas, well, you still have to pay your California source income. Something to understand is there is no separate capital gains tax rate for California. It is all income taxes. So 100% just counted as income, and that goes as high as 13.3%. Obviously, most people want to avoid, at least delay or avoid entirely the tax bill. We'll talk about that. We'll talk about how to preserve Prop 13. We have a lot of clients that are living in coastal areas in California typically, and they say, we're living in LA, but our kids moved up to Grass Valley in Northern California. We want to be closer to our family, so we're going to sell our LA property. We're going to move to Northern California. We're going to talk about some ways where you can minimize tax and also keep your Prop 13 taxes, which is really important. I would say that too often people come to us when they already have a deal done, or they say, Jim, I sold this property. Here's my $1 million tax bill. Help me fix it. Please come in before you have that purchase agreement in place. Really, as you're starting to think about selling the property, that's really when you want to involve your A team. And we'll talk about what an A team is. And so let's look at some common pitfalls and some planning strategies. And this is really, it's very important to realize this is before you sell the property. Okay. It's not before close of escrow, but it's before you have that signed agreement. So a lot of these you have to do in advance, but it's something you have to be really proactive on. So we're going to talk about the capital gain structure. We're going to talk about the 1031 exchange, which is the basic tax deferral strategy when it comes to real property. We will talk about a reverse 1031 exchange. Spoiler, this is where you buy the replacement property before you sell the relinquished property. So you buy a property before you sell it instead of selling a property and then buying another. That's what that means. We'll go over some 1031 alternatives. We will cover Dave's dilemma. Dave, fictional Dave, is going to sell a property, and we're going to go through a few examples on how he can resolve his dilemma and then preserve your Prop 13 tax base. But really, the question I want you to think about as you watch this or listen to it, how much juice do you want to wring out of the orange? Okay, that's what we talk about in tax planning. So some people say, I want every last drop. Well, to get that last drop, you've got to squeeze harder, more fees, more headspace, more, there's more going on. Some people say, look, I want the biggest bang for the buck. I don't want this to fill my headspace. And what I'm talking about is some of these things are pretty complicated. And some people say, look, I want to simplify my life. I really don't care if I pay a little bit more in tax it's just not worth it to me to take it to the next level. I just want to, play golf all day and not worry about this stuff. So again, this is like going to be a lot of on your personal side in your own mind, how you view this. So I do want to talk to you about taxes. There are tax credits, tax deductions, and tax deferrals. The best thing on the planet is a tax credit. This is where the government gives you money. So instead of you giving the government money, it's flipped and they give you money. It's 100% efficient, meaning if I do this activity, if I buy a commercial solar project, I'm going to get a tax credit. So for every dollar I pay in this investment, and we'll cover this briefly, for every dollar I put in, I pay $1 less in tax. So fantastic, 100% efficient. It's a great, up to 100% efficiency, I would say, meaning, instead of paying the government, you're doing something else with your money. A tax deduction is where you the amount that you spend, if you spend $100 on an investment, for example, or spend $100 doing something, it reduces your taxable income by $100. So that saves you, 37 to 54%. 54% is the combined state and federal and net investment income tax rate. So if you're in California, that 54% is your top income tax rate, and you need to pay attention to that. Tax deferral is really credits are best, deductions, not as good. And then coming in third is tax deferral. But sometimes this can actually, depending on when people die, and we'll talk about that because you always have to talk about death because it's estate planning, tax deferral can also be a very powerful strategy. It's very important to understand you pay your taxes later. When you defer your taxes, we're in tax year 2022 right now. If you defer your taxes for 2022, you may pay those in 2025 or 2029 or 2045. Think about inflation, right? And so the efficiency of this is tied to inflation. It's tied to the cost of doing this type of deferral strategy, your 1031 exchange, all those other things that go into it. And really the value in deferring taxes is you are paying literally the same amount, but later. So it's going to be less because of inflation, right? So very important to understand the power of deferral. So credit, deferral, or deduction, we'll talk about that. Again, how much juice do you want to wring out of the orange? Capital gains tax on a very high level. If you buy something for $1 and sell it for $3, you're subject to capital gains taxes. Currently, now this is added to your income. This is really important to understand. If your income is zero, you're not going to be paying capital gains tax. If your income is zero and you have a $20,000 capital gain, all of our clients are looking at a 20% capital gain, quite frankly, because if you're looking at doing some tax planning, it's going to push you into the higher bracket. So effectively, it's 20% for planning purposes. The recapture of depreciation is 25%. So depreciation, and I'll explain that in a little bit. That's basically if you have rental property and that has been depreciated, so your cost basis goes down, that recapture of depreciation is taxed at a higher rate. California has 10, count them, 10 tax brackets. I don't know why they need 10. It's too many for me to fit on the slide, but just assume that it's going to be 10 to 13.3% for the vast majority of transactions. So example, Dave buys Greenacre in 1993, which is 30 years ago, for $375,000, 30 tax years ago. The property is fully depreciated. Now it's in the 2020s. The cost basis has gone from 375 down to 100. Why? It's because if you buy a residential property in the United States for 375,000, I'm assuming $275,000 is structure, $100,000 is the land. That has been depreciated at a rate of 1 divided by 27.5 every year, which 1 divided by 27.5, if you throw in 275,000, it is a $10,000 income tax deduction. So Dave every year has depreciated Greenacre and put a $10,000 deduction on his income tax return. And the reason I mention this, the reason the number's odd, 375,000, is that the 275,000 lines up with the 27.5-year depreciation schedule, if you're following this. And it gives me the opportunity to remind you that when Dave goes to sell Greenacre, that 100 to 375,000 is going to be taxed federally at 25% because it's recapture. Anything above 375 is taxed at 20. Again, this is all stuff you typically work out with your CPA. You're not going to do it with the tax lawyer as much. The tax lawyer many times will say, why don't you talk to your CPA and have that CPA tell you how much your property tax or your income tax bill is going to be, and then we work backwards. So The $1 million gain is taxed at a maximum 37.1%. Now you might be looking at that and you said, Jim, I thought it was 20%. Well, 20 plus net investment income tax plus state income tax. So that is if you're in California. On the recapture, it's over 40. So the whole point in going through this is that's $486,000 potentially that goes to taxes. Now, something to understand is $375,000 in 1993 does not have the same purchasing power as $375,000 in 2022. What that means is your real, after your inflation adjusted, and now we're starting to think a lot more about inflation, right? Because inflation's stoked up. Your inflation adjusted terms, your tax rate is closer to 48% because I don't really count that 375 to 735. That's apples to apples. But when you back it out, what you're really looking at in inflation adjusted terms is closer to 50%. So it's a lot larger number. So probably the single biggest way that clients avoid capital gains tax is somebody dies, right? So Dave buys Greenacre in 1993, and the property's worth $1,375,000 the day Dave passes away. Wanda, Dave's widow, Dave is decedent or dead person, right? That's why it's Dave. We're going to kill Dave. Sorry, Dave. Wanda can sell that property for $1,375,000 and not pay any capital gains tax. So I would say on a very high level, when people say, Jim, how do I avoid capital gains tax? Well, the answer is somebody passes away. Now, this is true because Dave and Wanda live in a community property state, but not every state is a community property state. So you can think of like the states that used to form part of Mexico for all of 20 years between Mexican independence from Spain and the United States, after the Mexican-American War, that conquest of the northern half of Mexico. Those are all community property states, plus Wisconsin, and sometimes Alaska, and I think Tennessee maybe sometimes. So it depends. And where I'm going with this is you can forum shop, right? You can choose to go to Alaska or Tennessee and set up a community property trust. So if you're a resident of a state that is a separate property state, there are a few hoops to go through, but with proper planning, you can get this community property tax treatment. So what this means is if spouses own property is community property in California, one spouse dies, the surviving spouse gets what's called an adjusted cost basis. So the government waves a magic wand, and instead of this Greenacre having a $100,000 cost basis, that jumps up to $1,375,000. So Wanda, that's how Wanda can sell the property and not pay capital gains tax. So tax tip number one, it might make sense to hold assets until somebody dies. Okay. You need to verify if your state allows full adjusted cost basis on the death of a spouse or not. It might only allow a partial adjusted cost basis. So in these separate property states that are not community property states, you typically get a 50% adjusted cost basis. So a little bit of help, but not full. You also need to make sure if there are any state death taxes. So if you're going to be a kid inheriting this property, you say, well, I watched Jim's webinar if I wait, if you're a resident of one of those northeastern states that has an inheritance tax, you may have to pay an inheritance tax. So you have to weigh the taxes that you're paying, right? So not exactly completely cut and dried. There is some professional guidance that's needed, quite frankly, to make sure which way to go on this. And then the other thing too is you have to be mindful that right now death taxes are 40% on amounts over $12 million. In 2026, it will be 45% on amounts over $6 million. So that number is going to change. So you need to be mindful of that as well. So let's take a couple of questions here, then we'll move on to the tax deferred exchange and we'll kind of cover that. Anonymous says, I hope you will include advice, if any, for someone who has sold a property last year but hasn't yet filed their returns. Anonymous, that's a tough one. That's something that'd be one-on-one. Gary asked, does my widow get an adjusted cost basis on the rentals as well? Yes, Gary, that assumes that you and your spouse own it as community property. So rentals, stocks, everything gets an adjusted cost basis. What if the owner lives in California, but the property is in New Jersey, not a community property state? Ooh, Anonymous. Interesting question. You may want to consider creating an entity and holding that entity, the shares of that entity, not the real property itself, but you may want to consider holding the shares of the entity as a Californian. The other thing is I would really have to take a look at that. I would have to look at the title, because a lot of times the title is going to decide. And then otherwise you can have an agreement. So that's something I think we could talk about one-on-one. So let's talk about 1031 exchanges. This is a 1031 exchange is a reference to the Internal Revenue Code. You will see that abbreviated as IRC, Internal Revenue Code. That's where all the laws are relating to taxes. And 1031 is a noun, it's a verb, it's an adjective, it's an expletive. It's really entered the English language as a whole concept and a word and a code section. So the idea here is you sell one property and buy another property. And in doing so, you exchange those properties. So it's like for like, which is basically any rental property. So you can go to residential to commercial, you can go to industrial to vacant land. You can do a whole lot of stuff. Okay. So it's like for like. The idea is you defer the taxes and use the proceeds to purchase a replacement property. So in our example with Dave, if let's assume it's not a residence and now it's a rental or it is a rental property, that rental property would be sold. And instead of paying the $486,000 in taxes, Dave buys another property. And we have a slide that kind of covers that. But there are very rigid guidelines you have to follow. Otherwise, you can blow it, and then you end up with a really big tax headache. So here's how it works. You have to use what is called a qualified intermediary. So the idea here is when you do an exchange, it's not like you have a property, someone else has a property, and you want to sell yours to this person and buy this property at the same time. There's going to be a delay, okay? And we use escrows in California, but you do need this qualified intermediary. The problem with the qualified intermediary, they are absolutely not regulated by statute. So, Fred's intermediary, it might be Fred with a folding table, in a warehouse who says, yeah, I'll be a qualified intermediary. Why don't you give me your, $1.3 million bucks? Dave's going to be like, wait a minute, Fred, that's kind of weird. Maybe I should go use a bigger company. So I would just say, use the bigger companies that aren't going to rip you off. It does happen where qualified intermediaries have run off with the money. You can Google it. But again, it's an unregulated space. So buyer beware on that one. So those sales proceeds are held by the intermediary and it must be reinvested. 100% of that money must be reinvested. Now, can Dave put in $1.3 million and decide later, well, I'm going to take out 200? Yes. But that amount, 200, may be subject to capital gains tax. But what you cannot do is Dave can't say, well, I'm going to sell the property, hold on to the money, and then look around for a property and then by that. He can't do a 1031. That money has to go to the qualified intermediary, and it's investment property for investment property. So Dave buys Greenacre in 93, as we said. It's worth $1,375,000. Dave does a tax deferred exchange, and then Dave dies, and Wanda can sell Redacre, the replacement property, free of capital gains tax. So you can wait until Dave dies to sell Greenacre, or you can still effectuate that 1031 exchange. And then when Dave dies, Wanda can sell the property tax-free. So it's really a two-step. So sometimes there's a reason you want to sell Greenacre. Maybe it's fully depreciated, and maybe they're buying Redacre for $5 million and using 1.375 as a down payment to get more basis, right? So that they can begin depreciating again. So it's very common, by the way, in the commercial real estate space for owners of multifamily or big commercial properties. They typically churn those about every 7 years for a variety of reasons, but it's typically to pick up more basis to pay less income tax. So on this one, I can see a capital gains, a 1031 followed by Dave's death, and then Wanda, is able to sell the property tax free. So even if you're not going to hold the property long, you may say, well, Jim, Dave was sick and he was going to pass away, and maybe we should have just paid the tax anyway. No, go ahead and do the 1031 exchange, get a replacement property, because Dave is going to continue to own that property, and then that will avoid the capital gains taxes. Now, if you need some money off that, maybe you can do some debt financing. You can do what's called an offtake. So if they did that 1.3 million down on a $5 million property, they might be able to pull some cash out, right? And get the money. So a lot, by the way, just a little window onto the world, the people that borrow the most are wealthy people. You hear this like, oh, Americans are so in debt. Well, a lot of the debt that's borrowed is from wealthy people because they don't want to sell an asset to buy something else. that wealthy people will borrow from that asset because there's no tax when you borrow. There's tax when you sell, but there's no tax when you borrow. So obviously you have to balance carrying cost and interest rates and all of that, but it's just on a very high level what wealthy people do. So getting into the nits, the weeds on 1031 exchanges, the purpose of this is not to, right, counsel you on how to do a 1031 exchange. It's to make you aware of all of the crazy rules. And this is why this is not a do-it-yourself project. And I will list the professionals that should be involved. But this is something that, people say, I can do this on my own. I read a book, or I did this, or I saw a few videos. That makes me really nervous, because it's not the stuff that that is a problem, or the stuff that you don't know that's a problem, right? It's the stuff you don't know that you don't know, right? The unknown unknowns that are the real problem, and there are some gotchas. So day one is when you sell the relinquished property. So the term that is used is relinquished property. So when Dave sells Greenacre is the relinquished property. Dave has 45 days to identify a replacement property. So there are two stopwatches. One is 180 days, meaning Dave has to close within 180 days from the date of the close of escrow of the relinquished property. In this case, Greenacre, he has 180 days to identify Redacre. Well, Dave, let's say he goes out, it's day one, 10 days go by, we're into day 11. Now he has 35 days to identify a property. Dave identifies Blueacre, opens up an escrow. 2 months into the transaction, figures out this isn't for me. Escrow falls through. That 45-day clock, only 10 days have elapsed, even though we're, 71 days into the process. That 45-day stopwatch starts again. And then if he identifies Whiteacre and that stops for 5 days, you can see where I'm going with this is that 45-day clock. You do have 45 days to identify a property. You can stop and start it, but you have a whole 180 days to get the whole deal done. So sometimes that 45 days can bleed out beyond the 180. Many times people find themselves up against that 180-day time limit or the 45-day time limit. And then we'll talk to you about some alternatives that can fill that gap. So if you're watching this and you're like, Jim, oh my God, Jim, like we're at 44 days, I can't find a replacement property, or we're at 100 days and I'm really worried about coming up against that 180. There's some other things you can do instead of a 1031, or do them in combination with a 1031. So qualified intermediary, all 1031s need a qualified intermediary, a QI, okay? And the money goes to the qualified intermediary as after the sale of the relinquished property, but before the purchase of the replacement property. You cannot have constructive receipt. Constructive receipt means, you can't take physical possession of it. You can't put it in your bank account. You have to be really careful with this, okay? And there's some other little rules here, some rules of the game. There's a 3-property rule, a 200% rule, and a 95% rule. So not easy stuff. This allows you to identify 3 properties of any price anywhere in the United States. So to stop that 45-day clock, you can identify up to 3 properties. Even though you may only close on 1, you can identify 3. The 200% rule is you can exceed that 3-property rule so long as the total price of all those properties does not exceed 200% of the value of the relinquished property. So in this case, about $2.75 million in value in Dave's case. The 95% rule allows for identification of more than 3 properties if the fair market value of the properties actually received by the end of the exchange period is at least 95% of the potential replacement property. So little complicated rules. I'm not going to belabor the point. Just understand, you can see why this is not a do-it-yourself project. Again, the net asset value must be greater than the relinquished property. So you can't do like a cash out 1031 exchange. Okay, you have to leave some basis in there. The cash invested in the replacement property must be greater than the cash received from the relinquished property. So, if you're going to shrink down in size, you may end up with some type of capital gains tax exposure. The debt must be greater than the value of the debt on the relinquished property. So a few rules here. Again, I'm not going to get in the weeds too much on this. Understand that there are rules, and this applies to residential, single family, multifamily, industrial, commercial, double, triple net leases, and professional managed portfolios. And that's a key that we're going to revisit here a little bit later, is the professionally managed portfolio. And these are portfolios where you can buy a portion. So like if Dave found a replacement property for $1 million, but he goes, oh my gosh, I'm 375,000 short, he might be able to do a 1031 into that professionally managed portfolio of property and top off his 1031 exchange. Because as you're watching this, you're probably thinking, well, it's kind of hard to find properties, like, still kind of a hot real estate market. It's cooling, but it's still hot. And you go, well, and then the values have to be right. And all this stuff has to be, how is this all going to work? It's like the stars have to be aligned. That's true. It's a lot of work, so that's why you need an A team. That's me. Your A team is going to be your realtor, your qualified intermediary, your title company. I would say those are the real estate people. And then the tax side is going to be your CPA, lawyer, financial advisor. And then if you're taking on debt financing, your mortgage lender as well. So all of those people need to be working together. And like any kind of deal, you have to get, typically toward the end, you have to get a whole bunch of stuff done in a very short period of time. And all the I's have to be dotted, all the T's have to be crossed. These people really do need to work together. So before we talk about a reverse 1031, I'm going to answer a few questions here. Natalie asks, does federal recapture of depreciation still apply if a rental property is converted to a primary residence for 2 years prior to sale? Recapture does. It's my understanding, Nathan, it does still apply that recapture. So like if you have a home office and you're taking a depreciation on the home office, that's going to bite you, even if you never rent the property out, because part of it was, depreciated. If we have co-owners of an investment property, can one co-owner do a 1031 exchange with her TIC share, or do all the co-owners have to do a 1031? Anonymous, if it's a tenancy in common and not an entity like an LLC, each person does their own 1031 with their respective portions. I'm assuming that you would not be selling you might be selling just your share of the TIC and letting the other investors stay in there. If someone's willing to buy that, then that's kind of the nature of that real estate transaction, but you would do it individually. Can a 1031 exchange rental property ever be converted into a primary residence? Yes, I'll talk about that, Anonymous. I'll talk about a structure where you can do that. Venkat asks, if my spouse and I own rental properties and say when I die, my surviving spouse can sell them right away and pay no tax, even though she's a joint owner on the properties. Yes, Venkat. So this is one of the quirks of community property. If the property's owned as community property, which is a big if, and there's a lot behind that, if it's owned as community property, you get a full adjusted cost basis. It is I would say one of the very few tax benefits of living in California. Prop 13 is one of them. Another tax benefit is full adjusted cost basis. You do not get that in separate property states. What if the S Corp has title to the commercial property and we own the stock in the S Corp? How does the inheritance of the S Corp get a step up in basis? Does the property still get a step up? Anonymous, no. You get an adjusted cost basis on your stock, not the underlying property, which is a very complicated, there's a complicated series of follow-up questions that stem from that. But I would say that's a situation where the CPA, the lawyer, the financial advisor would be working together. But you get a new basis in your S Corp stock, but not the underlying property. Anita says, can you list the up leg within 45 days, remove it, and place another property in its place as long as you're within the 45-day period? Anita, that's a tough one. I know you're a realtor. I would defer to the 1031 company that you're working with, right? The accommodator. Then Kat asks for a 1031 exchange. Can you sell one rental property and buy two properties of the same equal value? Yeah, you can sell one. So if you sell rental for 10 million and buy two $1 million rentals, absolutely. You're increasing your basis. You just can't go from the 2 million to the 1 million. That's a little bit different, a little trickier. Anonymous asks, does a child who inherits a home from a single parent get a step up in basis the same as a surviving spouse? Yes, Anonymous. So that is correct. So in our case, if Dave died and he wasn't survived by Wanda, or Dave left it to son would get an adjusted cost basis. So a reverse 1031 is you buy the replacement property before you relinquish the property. So in this case, Dave buys Red Acre before selling Green Acre. So Dave buys Red Acre first, and then he's got 180 days to sell Green Acre. He has to use not only a qualified intermediary, but something called an exchange accommodation title holder. Sometimes we use an LLC on that to hold the title of the replacement property, and it's a qualified exchange accommodation arrangement. So if you see that term, qualified exchange accommodation arrangement, if you're buying a property, if you're selling a property, if you're engaged in a real estate transaction, and you see this on any disclosure, you know that the counterparty has done a reverse 1031. So we're going to talk about charitable trusts here. And then Walter asks, two more questions because I'm going to answer these. Walter asks, any tax savings tactics for the personal residence? We'll get to that. Anita asked, on the statement of professional managed, did you mean REITs? No, I did not mean REITs. I mean an untraded REIT. We'll get to that. So charitable trust. I want you to empty your mind. Whatever you've heard about charitable trusts, I want you to forget, okay? Because this is not about leaving charities money. Whenever you have a trust that is a charitable trust, one of the requirements is that a charity must get 10% of whatever goes into this charitable trust. The person who's giving the property can keep 90%. They can give 90% to somebody else. So a charitable trust does not mean a charity ends up with all the money. It's different than making a charitable contribution. If you make a charitable contribution to your church or your synagogue or your place of worship or the nature people or the animals, you write a check for $100,000, it's gone, right? That's not what we're talking about here. We're using the charitable trust chassis fundamentally as a tax deferral strategy. So Dave, age 60, conveys Greenacre to a charitable trust. Dave will defer the bulk of that $487,000 tax bill into future years. And instead of netting $888,000, which for some people is an extremely lucky number, today he will, and that's off a gross of $1,375,000 because I backed out the taxes. Instead of putting in his pocket $888,000 today, he would take a stream of payments over a 10-year period totaling $1.6 million and get a charitable deduction when he sells the property of $137,000. So that offsets that $137,000 is a deduction. So this is a deduction and a deferral, and he's going to pay, I don't know, $50,000 less, $60,000 less in income tax. And at the end of this 10-year term, I'm modeling this out as a 10-year term, a charity will receive, or charities will receive $319,000. So this works if Dave's already charitable. It works if Dave doesn't care about charity, because as you'll see, this has the effect of deferring taxes in a way where you can arbitrage the tax bracket. So what this looks like is, and we are in July of 2022. So I'm using the numbers these numbers change every month, and they're numbers based on what the IRS publishes. So if you're looking at this in a time other than July of 2022, know that these numbers do change. But what I want to share with you is the concept. So Dave puts Greenacre into this charitable trust, and in the first year he gets $289,000. Well, a good chunk of that is going to go is not going to be subject to taxes. So that $289,000, remember, he got a $137,000 income tax deduction. And so it looks like he's going to deduct close to, if not all of that $137,000. So that $289,000 is not really fully taxable. Yes, on the difference, the $150,000 difference, he's going to have to pay tax. But at $150,000, Dave's 60. He's just recently retired. He's not earning much money. He's not taking Social Security. So now he's in very low tax brackets. So when he gets these tranches, these $200,000, $215,000, $186,000, he is paying them at an overall less tax bracket than taking that full $1.375 million all at once. So if you take that all at once, you're pushed into higher brackets. You have to pay that tax today. You're not deferring it in the future and paying effectively less, in large part due to inflation, at least at the moment. So that's what that looks like. You can see in the lower right-hand corner, the charity gets $319,000 in 10 years, and Dave gets a sum total of $1.6 million in distributions. And I haven't done the tax modeling on this, but it's significantly less in taxes. So that's using a charitable trust. So if that's something where you go, wow, that looks kind of interesting, I'd like to use a charitable trust, just reach out to us and we can talk to you and we can model that out. A lot of the software, frankly, if you want to go online and do it, I'm a big fan of Googling. You can Google charitable trust calculator and you can start putting the numbers in. You just need to know how to put them in. And that takes a little bit of education, but I think it's something to look at if as potentially a planning tool. You do need a lawyer if you're involving a charitable trust. This is not something, you can go online and do it yourself. These are way too complicated, too many variables. This is definitely this is like prescription meds that are injected with a needle. Okay. Like you don't want to mess with that stuff because it could have a really bad outcome. Let's look at the Internal Revenue Code section 121 exemption, $250,500. If I'm a single filer, I get $250,000. If I'm a joint filer, I get $500. So if I'm a single filer, I get 250. If I'm a joint filer, I get 500. Doesn't matter if it's my separate property. So, in Dave here, he's married to Wanda. Dave, this might be his separate property asset, right? He still gets a $500,000 exemption because he's filing jointly. So it's something to know. Again, Dave buys Green Acre a long time ago, 30 years ago for $375. It's gone up $1 million in value. He's lived in the property. So somebody had a question. I think it was Walter had a question about, hey, what about the house? If he sells Green Acre, he can exempt the $250,000 in capital gain. And, with Wanda, he could exempt 500, but let's pretend Dave's not married. And it exposes him to a $750,000 gain and about $278,000 in taxes. So how can that is a lot of money. For really rich people, $278,000, yeah, it's a lot of money. But if you're Dave and you've got this and maybe a state pension and, you want to move somewhere where it's cheaper, this is $278,000 is a crazy amount of money to pay in tax. There has to be ways to, right, there have to be some options. Sell the home and pay your tax. That's an option. It's not a good option. Here's what, and there was another question, can you rent the home? This is what I see quite a bit. My parents actually did this. So what you do is you have a residence. So Dave has his residence and he rents out the home for 2 years. In the third year, but before the fourth year, Dave sells the home and he effectuates a 1031 exchange. Now, what he can do is he can take his $250,000 Internal Revenue Code Section 121 exemption. What does that mean? He can pull out $250,000, right? He can take that tax-free. He buys a replacement property with the balance. And again, you have to follow all these rules, but he buys a replacement property. He should wait a couple of years to move into that replacement property, continue renting it out, maybe for a couple more tax years, and then convert it to personal use. So that is a way of deferring. That is a way of deferring your taxes on a property that is your own property that you rent out, right? And so let's say Dave's going to move to Texas. He rents this property out. He buys a home in Texas. He has enough money to buy a home in Texas. He rents out the California house for a couple of years, then sells it, buys a replacement residence in Texas, rents that out for a couple of years, then he can move into it. You got to be really careful with the strategy though. And the reason I say 2 years is really it's good to have it on 2 income tax returns as a rental. So it maybe not be, it's 2 tax years, not necessarily 2 calendar years. But again, this is something you're really going to want to talk about with your lawyer, your CPA, frankly, your financial advisor to see if it's feasible, maybe a mortgage lender. If you borrow money on your residence and then buy a replacement residence, you may want to borrow the money before you initiate this plan, because if you're borrowing money on a rental, you may not be able to borrow as much. It's different kind of financing. So again, this is kind of like pulling a thread on a sweater. You really do need to check in with your advisors on this. So this tax tip is converting a personal use residence to a rental, and it's long enough. You need to have it long enough to consider to being a rental, but not so long it blows your 1031 or your Internal Revenue Code should be 121. The reason I had not longer than 4 years is because if you have lived in a home for 2 of the last 5 years as your residence, you get to take that $250,000 or $500,000 exemption. If you rent your house out for more than 3 years, that has not been your house for more than 2 years. It's just basic, simple math. 5 years is the statutory number, and you have to live there 2 of the last 5 years. It could be years 4 and 5 ago, right? Or I guess 3 and 4, depending on how you count. But it's very important that you not go beyond that 3-year period, because you'll lose that 121 exemption. Again, all the numbers have to work out. That's why we had that slide up there where you have to, the 95% rule, the 200% rule, the 300, the 3 properties, all this stuff has to work out. This is one of my clients who has an extremely large portfolio of properties, and very, very large portfolio, lots of zeros, asked me this question. And I'm in a little spoiler alert. There's this napkin here that says, that's a horrible idea. What time? I have not done this, but this is something, if I know a lot of lawyers are on this particular webinar. If you're a lawyer, I want you to think about it. If you've ever done this, please reach out to me. But here's what, here's what Dave does. Dave transfers the property to other family members who reside at the home as joint tenants. So here we got Dave and Wanda, and they got their 2 kids. And the 2 kids, they've been at home since COVID. And they're like, well, yeah, we've been here for a couple of years anyway. Dad, maybe dad put him on title a couple of years ago. So Dave puts the kids on title, maybe as joint tenants, maybe tenants. If it's joint tenants, it's not a change in ownership for California property tax purposes. That's why I put in joint tenants. If it's tenants in common, it is. But Dave says, yeah, Dave and Wanda will convey the property to Dave and Wanda and the two kids, son and daughter, all four of them as joint tenants. Well, you get four $250,000 capital gains tax exclusions. Now, when escrow closes, that money is the kids, but you've saved the capital gains tax. But again, they have to be living there at the home. So I don't know how practical this is in the real world. But as long as they've lived there 2 of the last 5 years, do you have to do a Form 709, which is a federal gift tax return? Yes, but this is probably a really bad idea. I'm just going to put that out there. But it may work. It may work in some extremely limited circumstances. And so that's why I would reach out to the Brain Trust here who's watching this. And please let me know if you've done this with a client. Option 4 is what we call mailbox money. And this is the example. Somebody said, Anita, I think you asked, is this the same as a REIT? A publicly traded REIT, which are REIT, REIT, is a real estate investment trust. This does not work with a publicly traded REIT, right? But Dave 1031s Greenacre into a managed portfolio of properties. Dave defers his taxes. He doesn't have to fix leaky faucets and plugged up toilets on Super Bowl, which is like, if you're a landlord, that's probably the one day you get the most calls, right? It's because someone's over there watching the big game. Dave gets regular checks in the mail. He didn't have to do anything. All the work is handled by professional managers, and Dave can buy as much or as little of this pooled investment as fits his needs. So we have a whole webinar on this. We have a whole section, I believe, on real estate transactions, tax planning. We have some other 1031 webinars. We covered this in detail. I covered it with Christina Lindsay Orto with Ascent Wealth Management on what this is. So the idea is Dave sells his $1.35 million property. That's sold, that's relinquished. And Dave says, the last thing I want to do is be a landlord. I want to go fishing. I don't want to deal with this anymore. So what does Dave do? Well, he reaches out to us and we connect him with Ascent Wealth Management, or he reaches out to Ascent Wealth Management directly and says, hey, I've watched Jim's webinar. I want one of these mailbox money deals. And so they help him get a property that replaces Greenacre with a professionally managed portfolio of properties. Now, some of these, I see these come through my office quite a bit. A lot of them are data centers. They might be, Amazon industrial type distribution centers. They might be multifamily, like 300 unit multifamily in North Carolina. So a lot of these different types of properties that lend themselves to be professionally managed. And that portfolio might own 90 properties. It might own 30 properties. So your risk is spread out among many properties. So it's something to consider if you don't want to deal with the underlying asset and want mailbox money. And then we'll cover some 1031 alternatives. If you guys have questions, we're almost to the end of our materials. And then we'll wrap it up. So Anonymous asks, what if I get a K1 loss on rental income due to cost segregation? Can those passive losses offset personal capital gain on the personal home? Anonymous, I believe so. You're going to want to check with your CPA on that, but I believe so. And a K1 is something you get from a partnership. Other 1031 alternatives. Let me start with the dirty dozen list, and there isn't a dozen here. The IRS publishes a dirty dozen list. And by the way, there are never 12 on them. So I don't know why they should just call it like the dirty 5 or something, whatever it is, or 4. These are things that I would pump the brakes on. And I see these come up in my practice because clients will say, hey, Jim, I saw this thing online, or this person reached out to me, or, Fred, the flaky qualified intermediary with the folding table in the industrial space said, talk to this person. Abusive syndicated conservation easements. What that is, conservation easement says, look, if I own a bunch of land and it's in the path of development, I can donate the right to develop that property to a land trust or some charitable cause. And you do get, it's called a charitable easement. You do get an income tax deduction from that. So an income tax break. So if you're a landowner, if you're a farm owner or whatever, and you do that, that is a legitimate transaction. That is not what I'm talking about. I'm talking about abusive syndicated conservation easements. So this is where people will get a 3 or 4 or 5x multiple. So you put in $100,000 and you pay $500,000 less in tax. If it's too good to be true, guess what? It is. I would stay away from the abusive syndicated conservation easements. So that's where there's a lot of leverage, maybe debt on there, some other corporate structures. But again, if you're the farmer and you're doing the conservation easement, I think you're this is, I'm not talking about that. Monetized installment sale, a monetized installment sale. And I know the one lawyer who's defending about 20 of these in front of the IRS right now. This is where you sell your property and you do an installment sale. So what that means is, so let's say Dave sells his property, say at 1.375 million. He says, if I take payments over 30 years, I'm going to spread out that capital gain over a 30-year period. I'll do an installment sale and I will sell that property. But instead of getting paid over 30 years, I want to borrow against that, right? And so I'll get paid out 93% on that 30-year payment stream. And that is a monetized installment sale. That's not where you actually take the money out over time, but you accelerate all those payments into 1 year. That is very dangerous. Okay. And again, I would pump the brakes on that. The Maltese pension arrangement. There's a Maltese pension plan out there. You can Google it, check it out. A lot of people push it. That is now on the IRS's dirty dozen list. I would, again, pump the brakes before you look at that. That Maltese is not the dog. It's the island of Malta. There's a tax treaty where you can convert assets to Roth IRAs and avoid tax is the bottom line. So again, that's a misuse of the treaty. You can see here abusive, monetized, misuse. The charitable remainder annuity trust to eliminate taxable gain. That is not what we were talking about on our charitable trust before. That was a different type of trust. That was charitable remainder unit trust. This is a particular variant that is on the dirty dozen list. So I want to highlight this. I want you to be aware of it so that you know there's some potential traps out there. This is something our firm, we're not in that space. So we just don't do that. There's a saying that in the IRS, well, the IRS and lawyers, is pigs get fat and hogs get slaughtered. Be a pig, don't be a hog, you'll get slaughtered. So the legitimate ones include the Delaware Statutory Trust. That is the professionally managed portfolio of properties. That was Dave's mailbox money I was talking about. That is the thing that's out there. And if you Google it, you can check it out. And there are a few providers out there. Qualified Opportunity Zone is the census tract designated areas that if you invest in these areas, the government wants you to invest in poorer, more impoverished neighborhoods. And by doing so, there's a tax benefit that can frequently offset a significant amount of capital gain. UPREIT is where you contribute the property to a subsidiary of a REIT. So if I have a property, I pool my property in. That is different than the mailbox money, but I put that in there because it's a variant. I don't see those in my practice. We just don't do those. So, but I did want to put that out there as an alternative. Commercial solar. This is big, and we've got big projects. And this is not where you put solar on your house, but let's say a big corporation says, "Hey, we want to be green. We want to use less carbon. We want cheaper electricity." So they have installed in their parking lot of their corporate headquarters a big solar array. And you might have seen these. There's like big steel things with panels and cars parked under them. That's the type of commercial solar that we're talking about, not what goes on your house. We have a webinar on that, a whole webinar devoted to it. And there are also light pole projects. And what a light pole? Well, now developers are realizing that when they put street lights in a residential development, they used to have to run wiring and cabling and power each of those lights using electricity from the grid. Now there are solar panels and batteries. And so that's like their own little power company. Each light pole is not connected to the grid. It's powered by solar energy using LED technology. Again, that's in our one of our solar webinars on our YouTube page. I'd encourage you to take a look at it. And Section 179 is basically, if you buy a truck at the end of the year and you're a contractor, you buy a truck for $100,000, you can expense that federally in that year for $100,000. State in California is still over 5 years. So that's like if a vehicle is of a certain weight. You can also do that with aircraft. You can expense those federally in 1 year. A lot of different opportunities out there that sort of counterbalance the gain here And then you've got some type of an offset here, depending on how you deploy an investment. We'll take one question here, and then we'll move on to Prop 13. Jennifer asks, hey, Jennifer, how you doing? I missed what you said about CRATs to bypass capital gains. Why are they dangerous? It has to do with believing that you get an adjusted cost basis when you transfer the asset to the charitable remainder annuity trust. You don't. You don't get an adjusted cost basis when you transfer a property to a charitable trust. Whatever comes back to you, you're going to have to figure out on accounting wise how much is gain, how much is income. So by putting these properties into a charitable trust, it does not give you an adjusted cost basis. It's just a tax deferred zone. And that's, I think some practitioners out there are pushing the concept that doing a charitable remainder annuity trust gets you somehow magically an adjusted cost basis. Doesn't happen. Now, Prop 13, you can move your residence, your property tax base to another California residence. People ask me, well, if I move to Idaho, can I take my Prop 13 taxes with me? No, because it's Idaho and Prop 13 is in California only. The property you're moving your Prop 13 tax base from must be 100% reassessed. So this gets a little tricky. If it's not 100% reassessed, you can't move it. If you transfer your property to an original co-owner, you might not have reassessment. If you transfer the property to a child and use that Prop 19 parent to child reassessment exclusion, the property's not getting reassessed. So you have to be careful who buys your property. Again, this is not a big deal for most people. Most people are selling it. You know, they're selling their home in the Bay Area, in Northern California or LA, and they're really worried that their, you know, $2 million property that has an $800 tax bill that they're going to have to pay $25,000 in taxes on the replacement property. No, you sell that property, you move your tax base to your new $2 million property, and it stays the same. That's what we're talking about here. Either the purchase or the sale, one of these has to occur after April 1, 2021. Now, we're in 2022 in July, so it is possible that somebody might have sold and bought a property before then and still be within the 2-year window, because there is a 2-year window. But one of these has to happen on or after April 1. You have to be 55 and over or the victim of a natural disaster or disabled. You can do this a maximum of 3 times. This is in addition to the inside the county rule. So if somebody says, I'm living in Santa Cruz County and I'm moving from Capitola to Santa Cruz and I want to transfer my Prop 13 tax base, you can do that once as long as you're over 55 in county. The big issues, frankly, arise when people move out of county, right? Because a lot of times people want to take their equity and either upgrade their home or put it in their pocket, but they want to keep their low property taxes. Okay, so that's Prop 13. David wanted to sell Greenacre for $1.4 million. Let's say they've lived in it. It's not a rental. They have a $500,000 capital gain. The sale of Greenacre results in a full reassessment. Because Dave's 55, they can move their, I should say, they have a $500,000 taxable capital gain, right? Taxable capital gain. And they move their property tax base anywhere in California. Dave reaches out. He says, Jim, we got this $500,000 potential capital gains tax liability. I might have to pay $130,000 in taxes. I really don't want to do that. What can we do? And we work with him to reduce his overall tax bill. And David wanted to live out their remaining years with overall taxes, leaving a greater legacy for themselves, their children, and their grandchildren. So that's kind of the whole point of this is, you know, Dave and Wanda, they're going to sell the big house. They have a tax bill. Yes, there's a lot of stuff you can do. You know, what we're not talking about here is converting it to a rental or all these other things that they could do. But the idea here is before you even start the process of moving or selling, reach out to your lawyer, reach out to your CPA, financial advisor, and really pay attention to this, because this is something that, you know, you need to measure 6 or 8 or 10 or 12 times and cut once. That's it, the end. And you need to get an A team. That's me. My book, Savvy Estate Planning, is available on our website. It's what you need to know before you talk to the right lawyer. Now, this is for anyone, not necessarily just coming to our firm, but if you're going to go see a lawyer and it's not us, you should still get this book, because this book covers all the stuff the lawyer's going to ask you. Like, you know, do you want to protect your kid's inheritance from a divorce, your kid's divorce? That's kind of a big deal, right? So here's our YouTube page. Check it out. I would really encourage you to go visit that. We have a tremendous amount of content, and subscribe to our YouTube page. How you contact us, you can go to our website and schedule a free call, and then we can see if it's a right fit. and review us on Google. And if you're a lawyer watching this, you should Google yourself and look at your own Google reviews. I was on a call today with another lawyer who didn't do that, and they had one-star review. You probably want to check that out if you're a lawyer watching this. So we'll open it up for questions. Anita says, great info. Thank you, Jim. Jennifer says, thank you. All right, so we'll give a couple more minutes. And if I don't see any more questions, it has been great spending time with you, and we will see you next time.